All eyes on Wall Street this week following a much-anticipated speech by Fed Chairman Jerome Powell, who's hinting he's willing to hike interest rates yet again.
Yeah, so what does this mean for borrowers? Jen Sullivan has you covered.
A Goldilocks speech from the Fed, making Wall Street and consumers a little nervous. On Friday at an economic summit in Jackson Hole, Wyoming, Federal Reserve Chair Jerome Powell said more rate hikes are still on the table.
We are attentive to signs that the economy may not be cooling as expected.
A hike in interest rates means higher borrowing costs for consumers with credit cards, home, car, and personal loans. This comes as mortgage rates are already sitting at a 22-year high. Experts say if you're looking to make a major purchase like a home or a car, either delay it or brace for higher costs. And expect stricter requirements when it comes to applying for a loan.
Bank lending standards have tightened and loan growth has slowed sharply.
The Fed's forecast follows several batches of data showing inflation is cooling. But the Fed isn't ruling out more aggressive action to bring down the pace of price increases.
2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal.
Powell says the Fed's target inflation rate is still 2%, as it aims to slow the increases in prices and cool down the overheated economy. But one prominent economist says the U.S. economy is stable and says the Fed can stop raising interest rates.
People are betting that the economy is pretty resilient, and if it starts to show signs that it isn't, expect those rates to come down.
This week, as investors soak in the Fed's message, there's concern it could send stocks plunging amid concerns continued rate hikes could tip the economy. For Consumer Watch, I'm Jen Sullivan.